Hey, cash flow maximizers. Today we're going to talk about whether we should set up an infinite banking policy or a dynamic banking system during a recession or during a pandemic, which we're currently in. So the short answer is absolutely, and let's get into why.
Oregon Cash Flow Pro offers free money management advice to help you take control of your finances. And now here's your host, personal finance enthusiast and licensed insurance broker, James Barber.
Okay, why would you want to set up an infinite banking policy or a dynamic banking system in the middle or at the beginning or at any point near a recession or with the pandemic that we're facing? Let's start with the infinite banking concept. The infinite banking concept is a savings type asset that we're setting up, and it uses a product called whole life insurance. And these are specially designed high cash value whole life insurance products. Now, right now, we're in the middle of the coronavirus pandemic with COVID-19. A lot of people are unexpectedly getting this, they're getting infected and they're passing away, even if you don't currently have any underlying issues. Now, if you have some underlying issues, you're at a higher risk. But since basically everybody is susceptible to this, we need to seriously think about our financial future and what we have to offer our families if we were to pass away, or if one of our family members were to pass away. Because right now, it can happen to anyone. And it's kind of a scary time. So one of the things that can relieve at least some stress is having a life insurance policy that is set to pay out and help your family not only get through this mess, but also help to cover any losses that they may face. As a case in point, I have hundreds of thousands of dollars worth of life insurance on myself. My wife has a couple of $1 million worth of life insurance. My kids have some life insurance on them. So if tragedy were to happen, if something were to happen to them, number one, there would be a death benefit that would help us and give us time to grieve without having to worry about our financial situation. Number two, the way that we design these policies is even if nothing ends up happening to them, we're going to end up in a good situation for cash growth down the road. Number three, even if nothing happens to them, we have access to the cash value in these policies. So that ensures that we can get these policies started, get a very large death benefit to go along with them, but I'm not tying my money up. I still have access to it if I need it. So a recession is also just starting, so we kind of have to worry about our cash flow. A lot of people are losing their jobs. They're not going to have the same amount of cash flow. Well, good news, because these kind of policies are designed with a very low base premium requirement, but the ability to dump in a lot more money if you're able to. So during the recession, if you lose your job, whatever the case may be, that limits your cash flow, you can drop down what you're paying into the policy to a minimal amount. So if your annual premium is set at $15,000, you could reduce it to $1,500 and still have that full death benefit that we set up for your policy. And you also have the ability that once we get out of this, that you can catch back up with those payments. As long as we don't go too long without making extra payments on top of the base premium. Now, of course, this depends on the policy design and the carrier that you're using, because some carriers are not as flexible with what they allow you to put into the policy throughout the year. So really, the ideal time to set up one of these policies was 20 years ago, but the next best time is today. So that's why I say absolutely, it is definitely the time to start one of these. And if you're in a situation even where you still have some debts to pay off, we can talk about ways that you can fund your policy and still pay off your debt at the same time. And you'll end up in a better situation at the end of it, but you'll have the full death benefit right now while we're still in the middle of this pandemic. Because as of right now, none of the life insurance companies have adjusted their rates. You're still getting the same rates that we were getting before this pandemic. I know, kind of crazy, because a lot of people are dying. That was unexpected. So there may be a change in life insurance rates in the near future if this ends up really taking its toll. But we're hopeful that it's not. Regardless of the situation, you can still get life insurance policies for great rates, and I highly recommend that you make sure that you're covered. Now, dynamic banking. Should we start the dynamic banking at this time? Well, dynamic banking utilizes home equity lines of credit or other lines of credit, including credit cards. We're basically using debt to pay off other debt faster. So in the time of a recession, it may be harder to qualify or get those lines of credit extended to you. Or if you already have a line of credit, that may get reduced by the bank or the credit union. So that's something to be aware of. You may end up in a situation where you get in trouble if you're trying to use dynamic banking and you put a chunk towards another debt, and then suddenly your bank reduces your credit line. That could get you into trouble, especially if you just lost your job. So one of the things that we want to take into consideration is if we're practicing dynamic banking or velocity banking and the economic future is uncertain, that might be a time for you to max out that line of credit. Just pull all the money out of that line of credit so that you have it. Because if the bank wants to reduce that line of credit, they can do that. But if you've already got the money out, your payments on that is contractually set. They can't just call the loan due at any point, although they can reduce the credit line at any point. So if that happens, when they reduce the credit line, if you've borrowed more than that credit line, when you make a payment, you just won't have that credit available. Not until you get below that new credit line, and then you can go back up to it. So if we're in a recession and housing prices have reduced, you may find your home equity line of credit reduced. If you have a line of credit and the banks are getting tight for some reason, you may find them tightening up on how much credit they have available out there. If there's a run on the banks and they're having a problem keeping up with reserves, again, you may find the same problem. They just won't have the money to be able to lend, so they're gonna have to cut back on what's available for credit. So the way that we get around that is if you have a line of credit and the economic times are uncertain, you may think hard about pulling out that extra money. For example, if you have a $20,000 line of credit available and you only use $10,000 of it normally, if you pull out that extra $10,000 and you're paying 6% interest on it, let's say you needed it for a few months just to be safe. You wanted to bring it home and just have cash, or you wanted to put it into another account that you had readily accessible. You might pay a few $100 worth of interest on that, but that may be worth it to have that peace of mind. It's really not that much. And then if the economy comes back and your line of credit is still where you hoped it would be, you can always put that money back in there and it only costs you a few $100. That is a lot better than an alternative scenario where you chunked, they reduced your line of credit that's available, and then you found out that you couldn't make a payment or you overdrew your account now and it costs you a couple $100 in overdraft fees or late penalties. So that's one of the things that we try and think about is not only are we always trying to minimize our interest costs, but we also want to have a sound financial plan so that we're not getting in trouble. Because oftentimes those are our emergency funds, or it could at least be part of our emergency funds. For people that are struggling to get out of debt, or they're just really focused on trying to get out of debt, they may not have a 3-month or a 6-month emergency fund built up. And that's okay as long as we plan properly. So that's the point of this video. I want you guys to think about how infinite banking concept and the dynamic banking that I promote on this channel can help you get through these tough times. So I hope you found value in today's video. And if you did, please give me a like, subscribe to the channel so you can follow along as we put out new videos, and we will talk to you soon.